as some people get in here, I think the first step is to find the chat box. There's down there at the bottom middle of your screen, you should see the chat. Double click it. This is what Mitchell and I are going to be able to keep an eye on while we're doing this. And you guys can uh, ask us questions, anything along the lines of that right here. Also, while people are, give people a minute to get in here, let's figure out. I want to ask folks two questions and respond in the chat. Where you're calling from and whether you're a real estate entrepreneur or you own a small business. Put one of those questions, and if real estate, you can also share what asset class you're involved in, and if small business, you could share what industry, just so Mitchell and I can kind of have a little bit of info on where, who, when folks are calling in from. Good. So we have David Bradley, Dallas-based CPA over in your neck of the woods, Mitchell. We
All
have
right.
Darren, real estate pro in San Diego. We have Matt, Fort Worth, small business owner. We have Romy, San Francisco real estate investor. We have business owner in Colombia. That's awesome. We have Grace, Chicago. We have Brian in Hawaii. We have Liam in, let's see, wow.
Aspiring CPA.
These folks are all over the place. Liam Harding is in New York City. He left me hanging there. He came back for more. Jonathan Loeb, I know him. Boca Raton.
The
And we
CPAs will
all,
keep us honest. This is great.
yep. We all have something in common. We want to give as little as possible to Uncle Sam.
If you want to give a lot to Uncle Sam, you just need to get off this call. It's my permission. Just hang up right now. It's okay. This is not for you.
Yeah, we have Ken in Houston, multifamily real estate. We have Eric, an investor living in California, but investing outside of California. I like that style. We have we have some Canadians looking to move to the USA and get some knowledge about the United States. We have Magnolia, Texas CFO advisory. All right, this is good.
Commercial medical real estate. That's good stuff.
164 people live. Mitchell Baldridge, this is awesome. I want to share a little bit, just an introduction on who you're talking to here. My name is Nick. I'm going to be the MC. I'm going to try to explain everything like I'm 5 years old. Mitchell's going to correct me, elaborate, and get a little bit more technical into the tax code. I'm a real estate entrepreneur. I own Bolt Storage. We have 64 self-storage facilities and two industrial properties under management, over 2 million square feet. We've raised about $45 million from LPs, over 300 of them. Operate under the brand name Bolt Storage. I also own somewhere.com, and I'm a partner with Mitchell and Ari Kosseg. Mitchell Baldridge is a great friend of mine and the smartest tax mind I know. He's a CFA and CPA based in Houston, Texas, owns his own practice. I think, Mitchell, you're at 200 plus high net worth clients, mostly real estate based. Is that fair to say?
Yeah, all small business owners for the most part. A lot of real estate. I'm a CPA and a certified financial planner, CFP. The CFAs they scoff at us, but
Okay, gotcha.
that's fine.
Good. Thanks, Mitchell. All right,
The the smart guys on Twitter.
let's tell people what we're going to discuss today. I think we're going to talk about bonus depreciation. We're going to talk about what July of last year and the Big Beautiful Bill did for that, how it works. We're going to talk about real estate pro status. We're going to talk about recapture. We're going to talk about 1031. That's kind of the real estate section, which I think it's fair to say real estate is one of the most powerful tools and levers you can use when it comes to tax reduction. Then we're going to talk about the Big Beautiful Bill, what it meant in July, what changed. We're going to break it down. We're going to talk about Section 179, QBI deduction. We're going to talk about R&D expenses. And then we're going to move into small business tax tips and a big one that is not good in the Big Beautiful Bill, which has been glossed over, and we frankly haven't gotten to read enough about it, which is the excess business loss limitation. We're going to talk about what that is, what it means, how it works. And then at the end, we're going to have a free gift. One of the free gifts is a 18-page PDF written by yours truly, Mitchell Baldridge, on how to put all this stuff into action. An organized breakdown. It's much better than the slides, much better than watching this video. That's going to be a free gift for you at the end, and two surprises that will kind of add some extra value. David asks, will there be a recorded version of this webinar? Yes, we will have a temporary viewing window to watch this workshop. We'll send you an email within the next week and give, I think, folks 4 or 5 days to watch the recording. Then we're going to do some live Q&A. How's it sound, Mitch?
Sounds great. Yeah, if you don't make them watch the video, they never do. So,
220 people live. This is the biggest workshop
holy smokes.
we've ever been able to do. So this is great. There's a special gift for us at the very end, something that Mitchell and I haven't done before, which we're pretty excited about. It involves getting you a kind of a free resource that is generally quite expensive to help with your unique situation. So pretty excited about that. Um, Now, depreciation is the most important part of this, Mitchell, and it's how a lot of real estate investors and entrepreneurs in general are able to make a lot of money and not pay much at all, if anything, in taxes. And the big beautiful bill supercharge this. So, why don't you give us the breakdown? I'll try to fill in the
Sure.
gaps where possible, and then we'll kind of tie it all together with how it works in a practical sense.
So yeah, if we're at the how to pay less tax webinar, I have a tweet of like kind of all business roads eventually lead to real estate, and real estate's the best, tax efficient business there ever was because you can get leverage on it, you can buy it freely with good debt, and you get all of this depreciation upfront that's out there today. So you get this kind of like tax free cash flow. So depreciation in nominal terms is like, let's say you buy a stapler, or you buy even a $900 MacBook Air. So there's this, that is an expense in your business. That's a supply in your business. You're freely able to write that off against your business income the year that you buy it. Nobody looks twice at it. But once you start buying $1 million buildings, even really, really big machinery and equipment, that's when you start to get into a different section of the tax code where this is a type of property that's a long life asset that's viewed on a longer time scale by the IRS. So typically, if you go buy a rent house, it's on a 27 and a half year window. So you get to deduct 3.5% of the property a year, versus if you go buy a office building, or one of these medical offices, you get 39-year deduction life. So you get to deduct 2.5%.
And this
It's worth
27 and
noting.
a half years and 39 years, these are outlined by the IRS as kind of the useful life of the asset. So it doesn't count
That's
land
right.
value. That's important. You pull land value out, that's non-depreciable at all. But if you buy a residential building, does this include multifamily as well, or is this only single family?
It's any type of living structure any structure that someone's going to live in. So it's a single family house, it's a fourplex, it's a apartment skyscraper.
Gotcha.
So every single type of residential building has a shorter lifespan than, they just assume commercial buildings are going to last a little longer. But
Yep. So
this has kind of always
27.5
been.
years is 3.63% of that price the value that you paid for it, straight line deduction every single year for 27 and a half years. You can deduct what would be in this example, you see $1 million building. Say it's a commercial building. If we spend $1 million on it, every 39 years, you deduct 29 or $25,600 against your taxes. So that in itself is quite powerful because if you buy $1 million building at a six cap, that's $60,000 a year of net operating income. 25,000 of that can be shielded, or 42% of it can be shielded, from the IRS and in the form of this deduction, this write-off, this phantom expense that you bought once and you get to deduct every single year.
And so assuming you had, a $600,000 loan at
Hmm.
6%, you're going to have another 36K of interest. So that 36 plus 25 wipes out all the cash flow, or sorry, not all the cash flow, wipes out all the taxable income from the building. The
Yep.
36 wipes out a little bit of the cash flow.
Yep.
So
Even though that 25K is not necessarily a actual line item going out the door expense.
yeah, so this is why real estate is the best business in the world. You can keep stacking up these properties and just put some moderate leverage on them, and so long as they pencil and you can pay the note, it's tax free all the way up until you're so rich that you have to pay taxes.
All right, so this in this example of straight line depreciation, which is quite powerful, we're looking at 3.6 or 2.5% of the value of your property that you buy. 42% or so of your net operating income can be shielded from taxes, but it gets better. So now let's talk about items with quicker depreciation. And if you're in a building, okay, the frame of the building, the structure itself may have a 27 and a half or 39 year, depreciable life, but there are items inside the building, different parts of the building that have quicker depreciation schedules. This is landscaping, sidewalks, parking lots. Stormwater structure is amazing for accelerated depreciation, earthwork, carpeting, accessory electrical, appliances, movable walls. That's huge in my industry of self-storage and overhead doors. These things, what you can do is you can go in and do a cost segregation study, put a value on these different parts, and you can depreciate these quicker. Mitchell, what's the lifespan, for example? Like, what's the useful life of landscaping, sidewalks, and stormwater infrastructure?
Yeah, so you know, that's all the kind of exterior side improvements are 15-year property. Some of these overhead roll-up doors, I believe they're 5-year property. So the idea that like everything fixed to the building that you would just sell along with the building, we're talking about when we talk about movable walls or overhead doors, those are interior overhead doors. The exterior overhead doors that are literally built into the frame of the building are still long life property. So they're kind of saying, look, it's this 39-year asset, but think about all of the component pieces of the building that are going to have a shorter life. And that doesn't include the roof. You go, well, my roof's not going to last 39 years, or even the HVAC. I mean, you're not going to pull out the HVAC when you sell the building. That's going to stay there. But all of the tenant improvements, all of these kind of pieces or like R&D facilities, all of that would be short life. All of this equipment, all of this stuff that comes along with the building that's not a part of the structure gets to be, and this is the whole, we'll get to cost seg, but this is the whole idea is you kind of blow this building into its exploded diagram of every one of its component parts like it's on a blueprint, and you say, here's all the landscaping, here's all the earthwork, here's all the carpet and the luxury vinyl plank and you
Hmm.
know accessory cabinets like those beautiful cabinets behind you. Like these are all not really a part of this office building. So we're going to call all this TI and separate it and then get to bonus depreciation. And
Yeah,
so
so I'll do my best to explain this in as simple a manner as possible. But a certain percentage of the cost, anything that's 15 years or shorter, which is all the things that I just listed, your landscaping, your appliances, some of your windows, your overhead doors, a lot of the different parts of the building are eligible for what's called bonus depreciation. So not only can you assign a value and depreciate them quicker under normal schedules, but as of now, and as part of the big beautiful bill that was passed in July of 2025, 100% of this value, anything under 15 years, is depreciable in year one. And if you're not paying attention, pay attention. Stop scrolling TikTok. Stop looking at your second monitor, checking emails, and focus on what I'm saying right here because this is a big gold nugget of what we're trying to get across from you here. 100% of the value of 10, 15, even 30% of the asset that you bought, how much of it is 15, 10, 7, 5 year life, is depreciable in year one. So what does this mean? Let's give an example in self-storage. You buy a $1 million building with $200,000 land value, $1 million property, all in purchase price. 800,000 of it is building value, of which 30% of that might be the overhead doors, the stormwater, the sidewalks, the concrete, some of these things that are eligible for bonus depreciation. That's $240,000 of the value. This is your bonus eligible amount, of which, as of July of 2025, 100% of that can be taken as a year one deduction. Massive,
yeah.
massive, massive, massive. So $240,000 on $1 million asset can be taken as a year one deduction. And this is why you hear so many people talk about buying real estate to get the bonus depreciation, the tax deductions. Now, there's risks to this, guys. We're going to talk about recapture. What goes up must come down when it comes to tax. You're going to eventually pay these taxes some way or another. So you have to be very careful about this. But if you put $500,000 down to buy $1 million building, like Mitchell said, you're going to borrow $500,000 from the bank. 48% of your cash down comes back as a year one tax deduction. That can be massive. So in an environment like 2021, when interest rates were lower and folks were buying buildings at 75, 80% leverage, not as common now, folks were literally getting more year one deduction than cash into a deal. And it was a very, very advantageous tax environment when it came to real estate.
This is why the real estate guys were just going berserk during zero interest. I mean, this is because you could literally take a very little capital down, go buy something, have a fairly low payment, and deduct more than what you put down year one, or as much as you put down year one. It makes it in effect like a 401k, but you don't have you don't have to wait till you're 59 and a half. You can borrow against it. There's kind of all these benefits of it.
Yep. And
For,
Mitchell, you talk about kind of the five levers of bonus depreciation, which I think are really powerful way to think about it. And all six of these different things can change your tax rate and change the
yeah.
advantageous, nature of this. Land value is very important because land cannot be depreciated. So if you're going to go buy an asset in a vacant land, covered land play outside of Manhattan, where real estate prices are very, very high, there's going to be very little depreciation. That lever will not be pulled. Now, if you're buying a property that's, very a very large building in a very rural area where land value is historically very low, that lever would be maximized, and you see, much room for improvement in the amount of cost seg advantages and depreciation that you can get. Lever two, Mitchell, you can go ahead and start ripping off a couple of these others.
Yeah, so back lever two is the percentage of what is that kind of long life property, that 39 or 27 and a half year property versus how much 5, 7, 15 year property is that. So, does it have a ton of site improvements? Is it an R&D facility where most of the value is in this very, very specific build out to this one kind of ideal tenant? Or is it just a tilt wall construction building that has nothing in it? I mean, we've
Yep.
gotten into some of those projects and we're just like, hey guy,
Yep. Block walls.
we
Yep.
didn't,
No,
there's
no
not much
storm,
we can
no
do for
storm
you.
water, not very big parking lots, block
Yeah.
walls, steel roofs, and very
Yep.
little material on site for actual accelerated depreciation. So that's
Yeah,
another
that's
huge,
a
huge lever of it.
yeah. You can get a storage facility that's literally made out of cinder blocks rather than having the movable modular walls, and it's just a whole different building. Lever three we just talked about is the percentage of leverage. If you buy it with 100% cash versus if you buy it with zero cash because you're assuming the loan, you're going to have very, very different situations happen as to how much of a deduction you're going to get relative to the equity you're putting into the
And keep
deal.
in mind that, maximizing some of these levers and increasing your tax advantage can also increase your risk as an investor and the chance that you could have losses. So
Yeah.
all of these bite both ways. So keep that in
So
mind.
yeah, this is leverage. Like especially in that ZERP phenomenon when people were doing highly levered deals, they were doing highly levered deals and then stacking on another chunk of leverage. Like uh, this is what accountants would call a deferred tax liability.
Yep.
You are borrowing money from the IRS that they don't quite know you're borrowing, or I mean, they understand it, but they're willing to let you do it. You don't pay interest on it, but we'll talk more about recapture. But when you sell this thing, you got to pay it back.
You're
So,
kicking the can down the road. And I think another huge lever here is how long you're going to hold a building. If you're going to hold a
yes.
building, 3 or 4 years, so deferring the taxes and paying those taxes 3 or 4 years down the road is valuable to you, which capital for most investors, real estate folks, entrepreneurs in general, capital is very valuable. So if you can get an interest-free loan from the IRS, you should do it. But you should know that you're going to need to pay that back. So some
And
folks
if
find
you,
themselves in situations where they depreciate. This happens in airplanes all the time. They buy a jet, they depreciate 4 or 5, $10 million. They depreciate it down to nothing. Then they have to sell it because they're in a financial bind. They sell it for 3 or 4 million. That entire sale proceed can be recapture and taxable. So even though you lose money on your deal, and you still have to pay back your bank many times, when you sell your piece of real estate, you can actually have a tax liability with no cash to pay it. So you got to be very, very careful about these things. And then
with your
lever four is the tax rate that you have. If you're in a very high tax bracket, this can be more valuable to you. If you're not in a high tax bracket, it's not very advisable to push that can down the road and take this as a loan from the IRS.
we
The
spend
percent,
a lot of time with like real estate pros saying, "Hey, let's not get you to zero. Let's get you to like 250,000 of income because you're going to be at the like 16% effective rate. Let's get you 16% times 250. Let's gladly pay it. And then let's carry your losses year over year over year because you're just going to lose $250,000 of losses that could
hmm
be used at a 24% income bracket or a 32 or the highest income bracket rather than on those lowest brackets as you get to zero or less than zero,
Yeah, working with
as it
somebody
were.
like Mitchell to plan ahead is very, very important in all of this. And then the bonus depreciation percentage, which is now permanent at 100 because yours truly got elected president, is lever five.
Yours truly.
No,
I don't think that's
Orange
yours
Man.
truly, but the yeah
So
the
lever six is the payback ratio and what you're gonna, how much cost you're gonna defer, how much,
so
what percentage you're gonna spend on your actual study because you need to go pay an engineering team, to do this work and get your building blown up and put values on all of it and give you a schedule to hand to your CPA.
it's a great time to talk about RE cost seg. We
Let's do it. Yeah, Mitchell founded. I'm a co-founder and investor in RE Cost Seg, which does this. This is what we do. We're not going to spend a lot of time giving you the big
sure.
sales pitch, but we have 45 engineers that are, they devote every waking hour to finding more depreciation inside of assets and blowing them up in AutoCAD and maximizing tax savings for investors.
And so yeah, what you pay for the study versus what the study's going to save you is ultimately a big piece of what drives the value. And if we'll give you a way to contact us towards the end, but when you contact us, we're going to just walk you through that, give you a free proposal, and tell you, hey, this is your property. This is what we see. Here's the conservative. Here's the optimistic view. Here's
Mitchell,
what
while I'm
it's going
running
to
through this
cost you.
case study, you should drop in the calculator so that people can play around with it because I think
The
uh,
calculator's awesome.
the
Yeah.
calculator on RE Cost Seg's website, you can plug in information about your asset, what you paid, what year you bought it, and that's when you
Logan
can. Yeah,
Logan beat me to this. So somebody said real quick, basically, what happens if I do a 2023 study today? What bonus rate am I going to use? And so we do look back studies, as we call them, all the time. If you bought a property in 2023 and you haven't cost segregated it and you didn't bonus the property so far, we can look back and we can do a cost segregation on your property, and then we can give your accountant a report of exactly how they can effectively catch you up filing this form 3115. And so if you put the property in service in 2023, you're going to be subject to the, was that 80%? We
60.
were
I
at
think it went down to
40,
60 at that
60.
point.
Yeah,
Yeah.
but you're going to be subject to the percentage rate of where we were, of like the people who put their properties in service on January 8th of 25 are jammed up because they're getting the 40. It didn't go to 100 until January 20th of 2025. So
Yeah.
that's how it follows it. It's not like you can play games and
Short-term rentals are an amazing, asset for depreciation. They're not necessarily great in all markets. The market is under some pressure for sure as an investment vehicle, but as a short-term rental, you can buy a building. Here's an example: $450,000, built in the 1990s, bought in 2022, eligible for 100% bonus depreciation, same bonus depreciation rate as 2026. The RE Cost Seg team did a virtual site visit, found 46% of the improvement basis as 5, 7, and 15 was eligible for bonus depreciation, and got $222,000 for as year one, uh, you know, bonus depreciation and tax deductions from the cost seg study. Pretty awesome.
Yeah,
$82,000 in tax savings.
we'll talk about real estate pro status and STRs in a little bit. But
Yep, we kind of went over this example of a self-storage facility already earlier in the presentation, so we don't need to spend too much time on this. Here's a short-term rental with $185,000 of depreciation. It was purchased for 1.3 million.
look at
Found.
that land value. That, but it's still remarkable that the 1951 house has $700,000 of improvement value. I mean,
Mhm.
they paid 40 grand to build that or
Yeah,
less.
very very high value land here in California. So
That was a big thing that happened in 2017. Before the Tax Cuts and Jobs Act, you could only bonus depreciate brand new delivered property into the market, where after 2017, they included used property. So that's kind of what blew this whole market open. Where like before that, you had to build a new house to bonus it. And then you wake up and you say, "Oh, I can buy a house from 1951 and put a coat of paint on it and get this huge tax deduction."
we
So
have some really good questions coming into the box here, Mitchell. If you want to pick any of those out, we have a $13 million Missouri multifamily asset that got 1.805 or 1.84 total in depreciation with a cost seg study. High land value again, 3.9 million is what they paid for it. They developed it in 2023. It's a good
they should
asset.
send us that. Cost tag study. We'd love to look at it and
So
give them some
this is a
pointers.
really important part of all this, Mitchell, and it's not necessarily good news or sexy. And it's that the government actually, treats different taxable income from different sources differently. You want to talk briefly about the two? Let's just simplify it into two types of income for folks and
Yeah.
what that means.
So it, simply your ordinary income, either from your W-2 job or from the business that you own and operate that you go to work at every day, is called active income. Then there's portfolio income, which is interest and dividends and kind of bank product income, capital gains. That's one chunk of income. And then there is something called passive income. And so in the 1980s, a bunch of hedge fund guys played a bunch of screwy games with the tax code. And then they revamped the entire tax code to build these different types of income so that you couldn't go invest in real estate and just wipe out your millions of dollars of leverage buyout income. They figured out how debt worked, and then they figured out how the tax code worked, and said, "Holy smokes, let's go!"
And then the
So,
government ended up saying that, hey, you have income that comes from your primary focus, basically. This is
mhm,
ordinary income. This is either your W-2, your main business. For some people, this is real estate, for people with the real estate pro status. And then there's passive income. These are, capital gains, capital losses of investments that you've made. These are potentially real estate investments. This is
I
investing as
gave
a limited partner, an LP in a real estate deal. If it's not your primary business, then it's two different buckets of income and it's two different buckets of losses. And those two buckets can't offset each other, right, Mitchell?
so
So if you
the
have, if you have,
IRS, yeah. So if you lose money in stocks, you get to take $3,000 a year. You can't lose money in interest, but if you go invest in a bar and you don't work at the bar and you lose all your money, you don't get to deduct it off of your ordinary income until you called the entire business a loss. But so real estate income, real estate rental revenue is by definition passive. So if you earn rent dollars to lease out real estate, the IRS in the tax code just says this is passive income or passive loss, as it were. And it may not offset your active income from your job or from your ordinary business unless you are a real estate pro. And to become a real estate pro, they are very specific. You have to work 750 hours and more than half your time, in real estate rental management, property management, construction, acquisition, they give you the categories, but you have to work your full-time job in that business. And
a
so,
business that you own at least 5% of, by the way.
yep. And
So you're
so
so
if
basically let's say we have somebody who's a stockbroker full time and they only spend, 300 hours a year and 10% of their time on real estate. They make big investments. They did not qualify. They cannot use real estate investment losses through cost segregation and bonus depreciation to offset their primary income, their W-2 income.
There was a tax court case last year where somebody basically was, hey, I'm a broker, but I don't really work hard at my W-2 job. And I really would spend all of my time working on this real estate portfolio. So I spend 1,000 hours over there and I spent 1,001 over here. And the IRS kind of said, we just don't buy it. You were paid for 2,000 hours over there. You did not spend 2,001 over here. You just couldn't have. That's impossible. And so basically, if you're a W 2 employee, you cannot be a real estate pro unless you're a W 2 employee for that owns 5% of a real estate business that employs you, you know.
Well said. So there's two loopholes. One is to marry somebody who is a real estate pro. We've been thinking about starting a dating site called RE Pro,
It's recapturedlove.com. We're still working on it, but
where you
yeah.
can find a real estate professional to marry. Because when folks are married, if you marry a real estate pro and you're filing jointly, if one person qualifies as a real estate pro, both people do, and you can use real estate investment losses, depreciation, bonus depreciation to offset the W-2 income. So sometimes you have a spouse who is a doctor or a stock trader or any number of high earning jobs, whereas the spouse is a real estate pro. They make investments as limited partners, even passive investments into real estate deals, and they indeed can use passive losses to offset active income because of the marriage rule.
Yep. But the second rule, you say, well, I can't make my wife do it. I can't make my husband do it. I'm not going to do it. I'm a doctor, and you get this, the doctor guys, you go, well, your wife could be a pro, and they're just like, she's not going to do it. It's a non-starter. Like, think of all the money you'd save. She doesn't care. So the second rule is STR loophole. So this comes principally, and I don't know if we're about to hit it next, but like, you could, if you were a physicians group and you see this all the time, now go back, like, you can buy your own building for your own medical practice. So the radiologists go buy the office building and they run the tech suite out of the bottom of it, and they have the labs, and then they have the clinic upstairs, and maybe they lease to like a podiatrist in the back. But like, they principally own and operate their own practice out of their own building. Like in Kansas or Indiana or like in the Midwest, every CPA owns their own building because the buildings are cheap and the rents are expensive, and they figure
And there's
out the
folks that
game.
work on cars that own their own building.
Yep.
There's folks who own trades companies like
So
HVAC and they buy their industrial building. And you're saying, Mitchell, if you buy the building that you operate out of, these real estate pro and material participation rules do not apply, and you can deduct these losses against your active income.
because the building is incidental to the business. You say, hey, rather than renting a forklift, I'm going to buy my own forklift. And rather than renting office space, I'm going to buy my own office space. And so we're going to principally operate out of this asset we own and we use in the normal, ordinary business trade to run our business. And so the STR loophole is the same principle, only it's a house and you're running a hotel out of the house. So you basically buy a house, or you buy a sixplex, or you buy a little trailer like
You're going to run an Airbnb short-term rental business out of this thing.
yep.
It's a higher touch business. You have to be the one who's doing the work. There's some rules around that. Talk to your CPA. We're running out of time. We got to get through this pretty quickly. But
Let's
if you're
go.
going to use it for less than 15 personal days, boom, all of a sudden active income and active losses, and these can cancel each other's out. So this is why a lot of high earners will buy a beach house. They'll go there for less than 15 days. They'll put it on a rental program. They will manage it themselves, and boom, they can use these losses to offset their active income.
Let's go.
Recapture. This is something that is very much worth touching on here. If you buy this $1 million building, we talked about 250K of depreciation taking over 3 years. Let's say later you sell it for $1.5 million. You're looking at 500K of capital gains, the 1.5 minus the original basis of one, and 250K of recapture, because the 250K is the depreciation that you've taken, and this is taxed at the recapture rate. So keep in mind that if you buy a building for $1 million, you borrow $1 million to buy it, you depreciate $250,000 of it. Then you have to go sell it for, 790,000. You're gonna have a taxable gain. There's a little bit of taxable gain there, even though you're gonna owe the bank more money than you sold it for. There's people who can find themselves in massive trouble by taking too many losses. Obviously, you can 1031. Obviously, you can do some other things, but keep in mind that recapture is the rate that you pay later when you sell a building on all the money that you depreciated on that individual building.
And so the recapture rate on the long life property is 25%, but the recapture rate on all the short life property that you cost segregated is the normal rate. And so,
Ordinary.
yeah, you have a lot, and ordinarily you're going to have a big gain that year that you sell the building, so you're going to get jammed up on the at the very top bracket on all the recapture. So if you didn't use the losses wisely, you're making a bad play here. So
Yep.
it's you just have to think it through.
Now, here's a plug. We're not going to spend a lot of time selling you guys, but we have a called a rapid report where we do $950 for a study on a lot of assets under 300, $400,000 total basis. And yeah, you get 10% off your first study with us, whether it's fully engineered or a rapid report. You can use Get 10. And again, I highly recommend going to recostseg.com and clicking on the calculator button at the top of the page and just playing around with it. I use that on assets I'm literally considering buying just so I can see kind of what happens and how much tax savings I could achieve with a specific purchase.
Yeah, it's a killer underwriting tool of understanding what
All
this
right,
is going to
ready
mean.
to shift gears. Let's keep ripping because we got 20 minutes left and we have a lot to cover here.
Let's go. Big beautiful bill. 100% bonus is back. We've already told you that. We're pumped up. Section 179, which is like bonus depreciation, but you can't drive losses with it. So it's a great tool for people who are buying equipment and other things. But it's not as useful now that 100% bonus is back. But that went up. The QBI deduction kept going, and you know it was on the chopping block, but it's back. R&D expensing is still around, and the 174 add back rules went away, so R&D expensing is back, and you don't have to capitalize all the expenses
Yeah, that
except
was
for
really
foreign
bad for tech. That
contractors.
was really bad for tech companies and software firms when they were literally out, laying out massive amounts of payroll for their engineering team and
Yep,
having to expense it over
capitalize it.
over 10 years. Insane.
Well, they were all at the inauguration, remember? The the business interest deduction. Yeah, we were getting jammed up about business interest, and that is all back. And the excess business loss limitation was made permanent. So we didn't talk about that. That's another kind of issue of when you're the high income active earner hedge fund guy who makes 2 million bucks a year, and you're trying to go take losses on the other side, you are limited to 300,000 about if single, or 600 if married. So like I had a hedge fund guy who made 10 million bucks and went and put a bunch of money in car washes and thought he was going to get this $6 million deduction, and realized that it was 600 grand a year, and that it was going to take him 10 years to use all the losses. And so
Hmm.
you look, if you're going to go buy anything for $6 million, you should probably call a lawyer and a CPA and understand what the hell you're buying and what is going to happen. Because you're taking other people's money, you're making big tax decisions. Consult a professional, please.
Yeah, and Andrew asks a very good question that Mitchell, I would actually be interested in hearing your response. He spends
Sure.
1.5 million renovating a commercial property. Is that considered a 179 deduction, or would that be a cost seg study and getting work done on that actual build out?
And he should cost seg it. We do cost seg studies all the time where we take, here's the shell, and kind of here's what you stripped out, and then here's what you put in, and here's a full analysis of this big property that's out there. That's right in our wheelhouse. And that's what the fully engineered study is for. Like, these guys are thinking through piece by piece, brick by brick. So
Yeah. Okay,
here,
good. So more for the small business folks here, Mitchell. Let's talk through kind of just laying it out, as an example, these tax credits and interest limits and standard deductions.
yeah. So with the big beautiful bill, they kept the lower tax bracket, they raised the standard deductions, and basically got rid of exemptions. They raised the child tax credit. They did some deductible car interest. They did the no tax on Social Security, the senior tax benefit. So ultimately, it's not really no tax on Social Security. They gave low income folks some different credits for kids and for seniors, so that and they did the no tax on tips credit as well. But if you fall into one of those brackets, it's worth getting your 2025 taxes looked at and done right. If you're a low income person and you're a senior, or you have children, like you got to figure all that out because it's
Yeah,
kind
this
of
is not
wonky.
this isn't necessarily only applicable for tax year 2026, right? This is the 2026 returns for 2025. Is that right?
Yep. Yep. And yeah, it's the first year that everything's phasing in, and so everyone's doing them all wrong, you know.
Yeah.
But um
Good. Um,
and
QBI deduction, salt, anything here worth touching on, or do you want to just let folks take
yeah,
a screenshot of
that
this page?
yeah, definitely screenshot this, but QBI is permanent, which is great because it was going to go away. The salt cap stuck around, or um bonus depreciation permanent. Corporate tax rate is a little bit lower. 179's up. Tip income, estate tax went up and kind of got codified forever. So this was big news last year, and now it's just kind of the land of the law, and or the law of the land, and all these CPAs are trying to figure out, in our first tax season, how to implement all this. So it's worth looking at all these, and if you fall into some of these categories, talking with your CPA.
Yep. Well said. So QBI is an important one. Do you want to give a couple more details on that?
Yeah, so the qualified business income deduction. So we run this business also called Better Bookkeeping, and it's bookkeeping, tax planning, and taxes for small business owners, solopreneurs. And so we kind of had the same person, this 250 to $3 million gross one person business, and you're just seeing more and more of these that are out there today. And some of the biggest opportunities that we see all the time, the people who show up and are just completely have never thought about taxes, these are the things they're missing up. So the QBI deduction, basically this new tax law, or this kind of extension of an older tax law, is that you get 20% deduction on your business income. So they lowered the corporate tax rate. And then for the small business guys, they threw them a bone to say, hey, all this pass through income, that's business income, we're going to just hand you this deduction on it.
So if you're married filing jointly, the first 364,000 of income to you, 20% of that, even though it's profit and it passed through to you through your LLC, can be a deduction.
Well,
That's pretty huge.
so everyone up to 364 qualifies, but then even folks who, own $2-3 million businesses, if they're not one of these specialty service trade businesses, law, consulting, accounting, professional athletes, musicians, certain things, they can actually raise their wages and figure out how the wage calculation should look and give themselves a bonus and qualify a lot of their income to this
Wow, that
20%
is
deduction.
huge, guys. Look, wake up again. Wake up. Stop checking your email on your second screen. If you run a business that makes 300,000 to $3 million a year and you're not using QBI, which is the qualified business income deduction, 20% of your income can be deducted, and you need to talk to a CPA about this. Pretty
So
awesome.
it takes your tax rate from 37% to like 30,
That's
which,
awesome. Massive,
it's
massive benefit.
meaningful. Yep. And so the S Corp election, this is something we do for a ton of people. These asset light kind of consulting businesses, we set them up, we get them an LLC, we create an S Corp for them. And what happens is there's what your business earns. Your business earns this 300,000 that's out there today, and then there's what you would be required to pay yourself as a salary for the efforts of running your business. And those are two different numbers. And if you do nothing, you just pay employment taxes on the whole number, on the 300. You pay FICA, FUCA, Medicaid, Medicare.
Yeah.
I mean, it caps out, but you'll pay 30 to $40,000 on this 300 number versus if you come in and you say, hey, we're just going to pay an appropriate, reasonable salary of 120. Like one of our constant clients is therapists. They come in and they were making like 120 working in some therapy practice. And then they go out on their own and they start billing $500 an hour like these therapists do. You would be shocked at what therapists
Yeah, but
are.
some of that 500 goes to the house. Like it's normal
So,
for some of that to be profit for the business, not necessarily a
yep.
reasonable salary for the therapist. So it
Well,
allows
they
you to
knew their
not
salary.
pay, you're
Yeah,
not
their
paying that extra,
salary.
yeah, you're
Yep.
not paying
Sorry.
that extra 15.3% in,
Yep.
taxes on the entire pass-through profit that you make, which is a massive part of it.
And
Home
then
office, this is a great one.
once you get into really really high earnings, you flip to having a high salary to optimize for the QBI deduction. Yeah, home office is big. I used to work at a CPA firm. I was a W-2 employee. I paid my own cell phone bill. I paid for my car. I paid for licenses and ongoing stuff that I wasn't reimbursed for. I got no reimbursement. I had an office in my house. I got no reimbursement. Now that I, own my own business, I have this chunk of my house that's exclusively office
You're
use, and I
sitting in it right now.
get to deduct internet and a lot of this this cool air that's blowing on me, all this stuff. It's good.
Yep. Yep.
But
R&D tax credit's a massive one. We talked about the fact that they made businesses capitalize a lot of these longer term investments in software and other things like that. So that's a big one. Let's keep going. Let's keep going forward though.
yeah, retirement planning, yeah, that business owners get this opportunity, especially solo business owners, of being able to do big pensions and big SEPs and all kinds of retirement plans that you just can't do when you're.
I see a lot of CPAs actually asking questions in the chat about cost seg for their clients. Reach out to Michael, Michael at recostseg.com.
Yep.
He gives CPAs the tools to offer discounts and work very closely with their clients when it comes to cost seg. So super important. All
Yeah,
right.
so Michael at recostseg.com, CPA partnerships. Lucy Petrie, thank you. Michael's the best. I like Lucy. Um, so yeah, retirement planning, you have solo 401k, cash balance plans, mega backdoor Ross. You have all these opportunities when you own a high earning solo business. Again, once you start bringing on tons of employees, you have to offer all your employees the same Cadillac Deluxe benefit package that you offer yourself. So then people start to tone it back a little bit because the employee
Mhm.
just wants more money rather than this 25% set match or whatever they're doing out there. So
We discussed section
179,
179 already.
business equipment, furniture, fixtures, vehicles, all kinds of stuff. The big thing is the vehicle that's under 600 pounds, that's a or under 6,000 pounds, I'm sorry, that's a passenger vehicle. That's specially carved out, and those are, subject to different rules. That's why the Chevy Tahoe or the Ford F-150 is the ultimate thing. So, oh yeah, these are my TikTok tax tips.
Let's start at the bottom, Mitchell, because I think there's a lot of things that people do that are not great. I think paying your kids for real work is great. I think, doing a solo 401k, I think that's very legit. Your SUV, you really have to use it over half the time, but if you do, that's a really good way to deduct some expenses. Your home office, people abuse that a little bit more. The Augusta rule, they rent their house, you can get 14 days max. That's a
and
legitimate and
people
fair
say,
way to
"Oh,
do it.
we hosted a dinner party and I paid myself $10,000," and it's like you could have just gone to a restaurant, guy. You know what I
Yeah,
mean? So
that's
like
yeah.
it just doesn't work. But yeah, um,
Yeah, a virtual seminar when you're in Cancun and you took the whole family there for 2 grand plus is quite ridiculous. Um, Doing every single meal, there's business owners that I know that take their wife out to Valentine's Day and drop the corporate credit card. Guys, you really have to think about what's worth it and what's not. If you're really trying to write off, $30,000 a year of meals and entertainment so that you can save, $12,000 in taxes and risk, a whole year for free in federal prison. You need to analyze your priorities and figure out if you need to spend some energy actually working on your business or trying to, rob Uncle Sam out of money. So I think some of this stuff gets pretty crazy, especially when they're talking about shell companies and there's a guy online who says, "I am a business. So personally, I'm a business." Right? Is that the one you were
Yeah,
talking
yeah,
about the
yeah.
image?
I have 2,000 businesses. There's that guy too. But yeah, real estate accounting pros says if you talk about real estate and your investors during Valentine's, it's fair game. So I think they're taking on new clients. So that's good.
No, he's joking around with us. Okay.
I know. Uh,
All right,
yeah.
so
So
I think to move towards Q&A, and we have something really cool that we want to give away right now. Now, I think you might be looking at this like, holy cow! I just got a lot of information. All of it was valuable. I took screenshots. I took notes. I have a list of things I need to go into ChatGPT and ask and learn more about. But hey, like this is all hard. Like, how do I implement this? How do I implement this stuff to my own personal situation so that I can see results? So, what if Mitchell and I gave you, here's a question for the folks in this meeting. We have 254 people live. What if we gave you um, direct access to our best US based CPA to take a 360-degree look at your real estate tax planning? Now, this CPA is specializes in real estate. He's not necessarily going to be the best guy to talk to if you have a small business and you're looking, to maximize your QBI deduction. But what if he looked at your real estate tax planning? Would that be helpful for you guys? Type in the chat if you think that talking to a CPA on our team about your situation would be helpful. Type it in the chat. It looks like Sean says yes. Jennifer said yes. Zach said yes.
all
David,
right,
yes. Nicole, yes. Nicholas, yes. Charles, yes. Okay, cool.
Matthew's about to get busy.
Now, why is this valuable? There's a guy on our team. His name's Matt. He's been doing this for a really long time. He's been a CPA for more than 10 years. He's very good at what he does. Mitchell and I pay him a lot of money. And frankly, you would be pretty smart to pay him for an hour of his time so that he can make your company quite a bit better. But today, we want to make this completely free for you guys. So now the bad news. The bad news is that we can't do this for everybody. We opened it up for 20 people. We thought it's funny because we thought we were going to have maybe 120 people live on this workshop, of which maybe 10 or 15% of the folks would want to talk to our guy. So we made it available for 20 people. We know that not everybody's going to be able to use this. It's first come, first serve. So go ahead, get your browser ready. I'm gonna drop a link, and the first 20 people out of 240 are gonna get a free 20-minute call with our CPA to ask some questions about real estate tax.
Yeah,
Um,
Matt is a CPA, tax
Here's the
tax guy,
link.
but
I'm gonna try to drop this link into the Mitchell. See if you can help me. Let's
yeah,
see.
he's a cost seg engineer though, and he's going to he knows as much as there is. He's been doing it for years and years. He's less on the small business side. We'll give you a link on the small business side as well at the end. Um,
Yep. And his goal, look, I told him this is not a sales call. We're not trying to sell cost segs. We want to add value to people. We want to add value to folks who are in the real estate business. We want to look at an asset of theirs, look at something they bought, look at a remodel they did, look at something they're considering buying, and talk to them about how it could fit in, talk to them about recapture, talk to them about land value, talk to them about how it could fit into their long-term plan, and try to add value to these folks' lives. So here we go. We got recostseg.com/CPA. There's 20 slots available. It's a free call with one of our best guys who is a CPA with the goal of, you know, adding value to you in your life. So if you book and attend a call, this as well, you'll get Mitchell's 15-page tax guide. And this is, updated after Better Business or after the Big Beautiful Bill. So you're going to get this. If you attend the call, uh, Matthew will give you access to this 15-page tax guide, which is kind of a recap of what we talked today. Have another couple offers here. You guys, Maurice says, I got a meeting who wants to buy it for $50. That's funny.
that's good.
I own somewhere.com. I'm in the real estate business. We have 60, like I said, 63 self-storage facilities, which we operate with 50 plus employees, of which six of them are in America. We have underwriters, we have our entire finance team, we have our property management team, we have our construction and improvement team in Latin America and South Africa. These folks are absolutely amazing. And if you want to get information on building your team internationally, you can use this link, somewhere.com/Emerson. And again, a free 30-minute call with somebody on my team who is instructed. Emerson is not going to sell you. He's instructed on helping you figure out who you could potentially hire to grow your real estate company. Because
Eh,
again, I can run my business with 1.3 million a year of overhead. My competitors are running similar sized firms spending $5 million plus per year. So these folks all over the world are amazing assets. And then
Emerson's the best, by the way. You're gonna love talking to him. He's a really really good guy, and I know I've met Emerson. I know Emerson, and he will not sell you something you don't need. He's going to tell you exactly what you need to do. I'm not
yeah, he'll
being
tell you
paid
who
to
you can
say
go.
this.
He can tell you where you can go get talent. He'll tell you how much you could potentially pay, what countries are hotspots, whether it's an underwriter who knows Power BI in Cairo, Egypt, or a software engineer to help you build your software to manage your properties in Bogota, Colombia. He'll be able to tell you where in the world to go, how to negotiate, what to do. Highly recommend talking to Emerson. And then Better Bookkeeping is the best way to work with Mitchell Baldridge, frankly. I'm a client of Better Bookkeeping across four of my businesses. It's an unbelievable service where I can log in, I can look at my P&L inside of it. All my tax planning is in there. All my K1s are available in there. It's direct access to awesome advice as well. And his offer is that he'll catch you up in 2025 if you sign up by March 15th, 2026. He'll do basically a free catch up, bookkeeping and taxes included, which is $7,200 value.
You
So
basically pay for a couple of months and you get started, and we catch you all the way up. We lost me. You don't
yep,
need me.
no, so go to betterbookkeeping.com/get-started. Schedule a call with Evan on Mitchell's team and get some additional tax advice and figure out if better bookkeeping is right for you. But
These
yeah,
are
that's
good.
it.
You'll love working with Matt. You'll love working with Emerson. You'll love working with Eric and Derek, Evan and
Tell
Derek
me if
at
you got
Better
a tell,
Bookkeeping.
comment in the chat if you guys got a spot. Were you able to book with Matt? Just let me know if you booked with Matt, Emerson, or Evan at Better Bookkeeping. Drop it in the chat if you were able to book an appointment. And yeah, hopefully we're adding some value to people. If you guys got a gold nugget from this workshop, please drop that in the chat as well. Looks like some folks wanted if you want to talk to a cost segregation specialist, but you didn't get a hold of Matt because his like very few of these folks were able to get with Matt. Um, we need to give Ivan's email here, Mitchell.
Yeah,
Ivan at RE Cost Seg.
I'm in with Anya. You're not.
Okay, good.
You're great with Anya.
Anya's amazing. Anya's amazing
Yeah.
as well. I think Matt might have gotten overloaded, so they're diverting a couple to some other folks on our team. So
Anya's in Houston with me. Oh, Esther's gonna pay $50. She's buying she's buying the other guy's booking. Perfect. So Maurice
but
and Esther, you connect offline.
send an email to Ivan at recostleg.com and he'll try to get you in with Ivan or try to get you in with Anya or Matt to kind of talk about real estate tax.
Um, yeah, so uh, we're wrapping up the hour, but we could stick around and take
Yeah,
a
let's do
couple of
5 minutes of
questions.
Q&A. What folks,
Yeah.
I saw some really good questions come in regarding real estate. But if anybody has Q&A, let us know. What do we want to cover here?
What are we
This
learning?
Tatiana has a really good question. I'm considering purchasing a single family rental that may need cosmetic updates, which she plans to do herself. Her main question is whether the time spent on renovation and work before the property is placed in service can count towards the 750 hours of real estate professional um, hours. Mitchell, what's your opinion on that? She's basically spending time in her building doing remodeling, improving her piece of real estate. I would think that would count.
Yeah, yeah, absolutely. So renovating, construction, reconstruction is all time that qualifies for real estate professional status. That's another like somebody who just my buddy Austin builds spec custom homes. And I always tell him, Austin, you're a real estate pro. You don't know this about yourself, but like you are sitting on a golden opportunity of you don't have to be a real estate private equity buyer, syndicator, property owner to necessarily be a real estate pro. You could be a broker, you could be a property manager, you could be a, you know, construction person. And whether you're constructing your own asset or other people's property, it counts. And you just have to own your own business. And like if you're doing work on your own property, that's owning your own business out there. So
Yeah,
those hours count.
a lot of questions about real estate pro status here.
Yeah.
I think just from a high level here, it's worth finding a CPA that will work with you to actually accomplish what you're looking to accomplish. And much more of this is CPAs sometimes don't want to do the extra work. So they act like they work for the IRS. They're like, okay, this is the rule of law. This is what we're going to follow. This is what we're going to do. And you could say, but what if? But what if? Just like how you go to your PCP now, your doctor, and ask him for extra blood work, and they're like, oh no, you don't need that. You don't need that. You don't need that.
You're gonna
Fi
upset the CPAs again, Nick.
Find a
Careful. Careful.
CPA. I've fired CPAs who are lazy and do not want to work with me to actually help me accomplish some of my tax goals. Now, I am not trying to do anything not by the book. They won't even tell me how to do it by the book. So go work and find a CPA that's willing to work with you, tell you what you need to do, help you with your record keeping, help you with your planning, help you with how you spend your time even, and what you need to be working on and what you can do and what you can't do so that you can accomplish your tax goals. That's a piece of advice for you. But the real estate pro status is nothing to play around with. Like the government is very serious about this. If you have a W-2 job and you try saying that you're working 51% of your time on something else, not going to happen. Sorry, not going to happen.
Yep.
So yeah, be really careful about this. Log your
Uh,
time, create an Excel spreadsheet, mark down how much time you're actually spending so that you have record of doing these things.
yeah. Look, Natifa Morris, even with a job, even with a real estate license, I had a W-2 job and the IRS just completely jammed them up, which they will. Yeah. You have to
So,
do this stuff by the
Mitchell,
book. This
Rudy
is,
has a good question, and I'll ask this of you. He said, I bought an asset in 2021, but I didn't do a cost seg. Can I do
yep.
a Form 3115 and, take some of these tax deductions on my 2025 return if I do a study?
You sure can. Yeah. And you have to file that election on time. So you have to extend your return and or get this done before the extension and file on time. So we do cost seg studies all the time, these look back studies for people who place the asset in service at the right time, but never, segregated the components of the building out there. And so we can help you with the study and we can prepare the 3115 for you to hand over to your accountant
And you
and just get it done.
come in with 4 years of deductions. It's a beautiful thing.
And in 2021, they'll get the 100% bonus. And so if it were like 23 today, you could potentially amend 2021, but because it's been so long, you can only file the 3115. You just have to uh go forward. So hopefully 2025 was a good year for you and you could use some losses.
Dashia says she works with a realty company and wants to send a lot of our clients to RE Costseg. Do we have a partnership set up? Yes, we absolutely do. Reach out to Michael at recostseg.com. We'd love to have you refer some business and give you some referral fees as well.
Brokers, yeah, but brokers, CPAs, you know, anyone, even clients who just want to refer their friends, we love referrals. So Michael at recoseg.com or recoseg.com
We actually pay
/partners.
$500. We pay $500 for every referral you send us.
So do that.
All right, good. Any last questions you see here, Mitchell? Are you ready to wind it down? Really appreciate everybody's time. Thanks for joining. Hope you enjoyed some conversation with Matt, and thanks for
This is our best one yet, for sure.
yep, killed it. Thanks, Mitchell.
Hey, thank you. Good job.
All right, talk soon.